Hello, everyone. Today on the final bar, I say happy Friday, happy distribution day, happy bear market. I don't know if we could declare that just yet, but we're certainly seeing further distribution in stocks. The S&P settling in just around 4,400, quite a bit below 4,800, which is where we were not too long ago. We've successively broken those key support levels, and on the way down, individual names have rotated lower as well, causing breadth measures to turn quite negative. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of the Final Bar. Happy Friday. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets. We focus on the language of technical analysis, the information embedded in price and what it tells us about the investor decision-making, right? What the aggregate reaction of investors are and how that is reflected in price. And if you're trying to get a sense of whether investors are rotating more risk on or risk off, you can look at a lot of indicators to try to understand that. But the best predictor, I would argue, or the best indication of that is price itself, right? What is the price of the particular asset or the major averages? What can that tell you about the overall trends? If sellers outweigh buyers, or if demand underweights supply, if selling pressure is too much and overwhelms the buying power, any of those sort of anecdotal conditions causes price to go lower. That is what we've seen. I think that's the story of this week, is a rotation from risk on to risk off that had been in place for a little while, but now really accelerating. This morning, it seemed like a potential buy on the dips mentality, right? We get down to the 200-day moving average, we bounce off a little bit, and the thinking is this could be the buy on the dips. This could be when buyers come in and start pushing price back higher, but it never was sustainable. We ended up bouncing up to yesterday's close, and then we continued this downward trend overall in stock. So certainly a distribution phase, and the question now is how far, how low, how long, and we'll try to see what we can answer with those sort of questions here today. We have a lot of great guests on this show. I had a lot of fun with Katie Stockton. I was thinking about her discussion yesterday, looking at the Ichimoku cloud model and looking at some of the trend reversals, the prospect of higher rates and what that means for growth stocks. And today we're seeing, I think, further movement in that direction, particularly the weakness in some of the FANG stocks, the growth stocks. Next week, three great guests for you. We have Chris Shivako from Shivako Capital on Tuesday, the 25th. On Wednesday, the 26th, we have John Kosar from Asbury Research. Jeff Hughes from JWH Investments in Minnesota is helping us out on Thursday, the 27th. Two other special events next week to mention to you. On Monday, the 24th, the guys at Go No Go Charts, that's Tyler Wood and Alex Cole. They do a really good job. They designed some really fantastic visualizations to understand market trends and try to make sure that you're in the right things at the right times. They're going to be doing a special presentation this coming Monday talking about their new ACP plugin. They've designed a plugin which you can access through the ACP platform on StockCharts. It's coming up on Monday, the 24th. On Wednesday, the 26th, our next episode of The Pitch, I'll be moderating that conversation. Mary Ellen McGonigal from MEM Investments. We have Jay Woods from Drive Wealth, and then we have Joe Rabel from Rabel Stock Research, each of them providing 5 stock pitches. Then we discuss them as a group. Go to stockcharts.com/thepitch for information on that event next Wednesday, the 26th. Let's go into our main segment here, Wrap the Week. 2 segments really on a Friday show. We have Wrap the Week. We'll spend some time. We'll take a break and then come back answering some questions from the Final Bar mailbag. I like to start the weekly wrap session going through a poll question. We always have a poll running on our live stream page on stockcharts.com, also through social media. We'll send them out occasionally, and certainly if you see those, make sure you respond. We asked you recently, how important is sentiment? Things like the AAII survey, the name exposure index, those are things we reviewed on the show yesterday. How important is sentiment in your process? 39% of you said somewhat important. 23% of you said very important. So Altogether, that's just over 60% of you saying that it's either very or somewhat important, which is pretty good. I think that's about where it should be. I would hope that that your answer lies in one of those two categories. If you answered in the other two, about a third of you said not very important, or I literally never look at those things, which is almost 20% of you. If that's you, listen, I think, should it be a primary input? I certainly wouldn't expect that, or would I suggest that? Should you make investment decisions based purely on sentiment using those survey data? Absolutely not. I think that's kind of a miss. Is it a really good way to complement what you're seeing in terms of price and breadth? 100% true, I would argue. And I think understanding what people are saying, understanding when fear is reflected in price, but also in some of the survey data, also things like the VIX and put call ratios, which I would argue fit into the category of sentiment, can be really helpful, particularly right now where it shows an elevated volatility, makes you think, look back to when previous times when volatility has been a little elevated and what the market has done in those scenarios. So I'd encourage you to check some of those indicators out if you've not looked at them before. Excuse me, continuing our Wrap the Week segment, let's look at our Wrap the Week chart. This is where we look at how the markets have evolved from last Friday's close to where we're at today. Now, we had a holiday week this week, so we're starting on the 14th, which was last Friday. We're going to where we're at today. What do the major asset classes do? In black, you can actually see right here is the S&P 500. Pretty rough day for a rough week for stocks. I mean, this is one of the most negative weeks for the S&P in quite some time. If I was a data guy, I would probably tell you specifically how, what the average return is and how far this is from there and what standard deviation or something. That's not really my mindset, but it's certainly just from anecdotally looking at this chart every week for years and years, I will tell you, it's one of the worst weeks we've seen for the S&P, certainly in quite some time. And you have to remember that the biggest drawdown in 2021 was about 6%. So we almost matched that just in this week alone, given the weakness that we saw going into the close. I'm going to refresh this just because we sold off to even more since I brought up this chart for the first time. So the S&P down 5.7%. A couple things underperformed the S&P. In pink, we have the NASDAQ 100 down almost 7.5%. In purple, we have small cap stocks, the Russell 2000 down 8%. So a really rough week for small caps. Everything else outperformed the S&P. This is emerging markets here down 2.25%. Not often that we've seen emerging markets outperforming the large cap U.S. stocks, certainly in recent history. The rest of these are actually up. Absolute basis for the week. In green, we have the U.S. dollar up 0.4%. That's using the UUP, which is the bullish dollar ETF. In gold is gold spot. That's actually using the GLD, but an ETF that holds physical gold up 0.8%. In red, we have bond prices up 1.1%, and the big winner in brown is crude oil using the USO, which was up 1.4%. On this next chart, we'll incorporate Bitcoin into the mix. You can see it was the weakest of the bunch, down 11% from where we were at last Friday. And interesting, I spent a lot of time today when I was looking at the markets, just looking at the major U.S. indexes and large names and just seeing what was happening and try to make sense of key support levels and where we should be focused. But then I glanced over to cryptocurrencies and saw that it was even worse, that the real negative moves were in crypto land. Let's look quickly here at just the returns today. We sort of saw the weekly movements, clearly a negative move for stocks this week. The S&P closing just below 4,400, right around that level, down almost 2% for the day. Certainly, the bounce earlier today was sort of a question mark. This was a sort of the point of no return. Is this the bounce, right? But the fact that we hit resistance at yesterday's close and then rolled over is kind of a classic bear market move where we just don't have enough gas, enough juice to even get above yesterday's close. That's not an encouraging sign. If you're looking for signs of stability and optimism going into the weekends, I certainly don't see that anywhere that I could speak of. In all intellectual honesty here, I see more distribution than anything. The NASDAQ composite down even more, about 2.7%. Mid caps and small caps down as well, but S&P 500, the weakest of those three. The S&P 600 small cap index down only 1.4%. Still a pretty decent down day. The VIX, by the way, is almost at 30. We're going to look at a chart of the VIX here in a few moments if I can remember to do so. We've got a lot of charts to try to get through here for the session, but certainly an interesting one. Bonds came, went higher today, and I think the question is separating the short-term from the long term. Short term, you're seeing stocks sell off aggressively. You're seeing, one of the few things that was actually positive today were bond prices, right? The fixed income markets going higher. Certainly, sort of a safe haven move, I would imagine, given the deterioration in stock prices and in breadth. You're seeing some people flock to the relative safety of treasury bonds. And that's why the TLT was up 1.2%. That's obviously putting interest rates lower. So the TNX is down below 1.8. It's down almost 175 here, just below that today. And that's, I think, two things that are happening right now. I think overall, long term, I think you're seeing that trend towards higher interest rates. I've talked with a lot of my guests about that, but yesterday, Katie Stockton and I talked about that with her chart looking at the 10-year yields and certainly a strong potential to go higher given the expectations from the Fed in 2022. However, in the short term, you're seeing a flight to safety, and that means the TLT is working. Dollar down a little bit using the UUP. Commodities, honestly, a little bit mixed today, and oil prices were up just a scratch. Gold and precious metals down a bit, and so the GLD was down about 1/3%. A lot of red if you look at cryptocurrencies. And I think these are some key breakdowns. We talked for a while about Bitcoin and a potential floor around 40,000. We actually violated that today. Talked about Ethereum and finding a floor at 3,000. That actually broke today. So we actually closed right at 3,000 yesterday. And that's a real big line on my chart thinking about Ethereum prices, because that is a big round number and it's where we found support previously. That broke and we're almost 10% below that level already, down 8.5% almost just today. So certainly a negative move. And if you think of cryptocurrencies in terms of overall measures of speculation, seeing a lot of weakness here. We're going to get to a couple of the charts here in our Mindful Investor live chart list. I just want to highlight two charts here very quickly. If we're looking at Bitcoin, that's this one right here. We talked about the 40,000 level as being so significant. This has been repeatedly tested from below and from above on the chart of Bitcoin. We broke that, which in my opinion means most likely we're going to head even further down from here. I wouldn't be surprised if we get all the way down to 30,000, which would retest the May, June, July lows from last year, which seems like a long way away. And it is. I mean, that's another 30% haircut. I'm doing the quick mental math. That seems about maybe not that bad, maybe 20, 25%, but certainly a big hit from where we're at, 38,000 down to 30,000, but certainly possible. And from a pure support and resistance perspective, there's not much below where we're at. We're currently testing the 50% retracement line, which we've highlighted before. Below there, you have a lot of support areas around that 30,000 level. That might be where we're headed next on cryptocurrencies, but certainly more negative than positive. And again, today is one big down day, but among many, right? The trend overall has been fairly negative. So if you bought Bitcoin recently, you're buying it because it's been down a lot, and you have to be prepared for this sort of environment where the trend continues to persist in that direction. I just want to hit very quickly here, just with a moment on the VIX, which is this chart right here. The VIX is now nearing 30, very, very close to that. The most recent time we were above 30 was back here at the end of November. Now, the S&P had not been down as much at this point. It actually just come down to 4,500 here, but the VIX spiked very, very quickly. That ended up being the end of that move, right? And if you look over the last 8 or 9 months, getting above 25 overall has been a pretty good a way to identify some of those actionable pullbacks. The problem is much deeper drawdowns have seen the VIX get well above 25, well above 30, and go even further to the upside. We even saw that fall of 2020, where the VIX remained above sort of 20 for an extended period of time, and even touched 35 to 40 a couple of times. I've talked about how I think 2022 is going to see the VIX spend more time above 20 than below 20. So far, that seemed to work out as the VIX is spiking higher. So there's no upper bound, really by definition. The VIX can certainly go higher, and we're seeing elevated volatility, elevated uncertainty. Let's finish off looking at the Mindful Investor live chart list. This is a chart list that I keep updated on StockCharts.com, and we're going to start with our market trend model. And I have to tell you, I haven't updated the text, but as of today, the market trend model for the medium term turning negative. For me, that's been positive since May of 2020. This is the first time it's actually turned net negative. And what's interesting is I had used a previous version of this medium-term model using the weekly PPO, it had given a number of false negatives along this move higher. And so I adapted the model and used this new medium-term setting, which I like a lot. I think it's tracked the trend very, very closely. The challenge is now it's turned negative for only the fourth or fifth time in the last 5 years. The only other times that that's turned negative has ended up being a fairly significant drawdown of sorts, either in price or time or both. That's concerning me a little bit about the downside potential with where we're at today. Short-term model has been negative for the last couple of weeks and remains so. The long-term model remaining fairly constructive, but that's fair. Even if we're 7-8% off of all-time highs, it's most likely going to be positive. We don't have time for many more charts, but I would point out the S&P 500 on a daily basis. We have very quickly in a couple days blown right through 45.50. And we talked about that pink shaded area as being key support. And I mentioned a number of times, as long as we remain above 45.50, I'm not going to get too negative because overall that tells you support is in pretty good shape. If we do break that, though, you're going to hear me be a lot more cautionary. And I think that's today, if not yesterday, right? We've continued to go lower. And I think it's driven by weakness in a lot of individual names, a lot of sectors, but particularly the breadth measures show you how negative the rotation has already been up until now. And I think there's certainly a high probability that we go much further than this. Getting below the 200-day moving average is a significant breakdown. That has not happened often in the last couple of years. And you have to go back to some fairly significant pullbacks to identify that. The next level is 4,300. That's these lows from September and October. That's already another 100 points below where we're at right now. But I would certainly be looking there. If you've not thought about what happens to your portfolio in the conditions of S&P 4,300 or 4,200 or even worse, I think now's the time to be doing that. I would spend some time this weekend thinking about that downside probability. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so much fun to do this show every day for you, and we really appreciate you joining us every weekday after the close. We're going to be moving back to 4 p.m. Eastern, running the show live on StockCharts TV and on demand as soon as we can get things posted a little later in the evening. So look for that move back in our live stream, putting the show back to right at the close every weekday on StockCharts TV. A couple quick announcements before we get to our next segment. First off, we love to hear your questions. You can email us your questions at any time via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. And just like we're doing today, we'd love to answer your question on the air in our next mailbag segment, which will be Tuesday of next week. Also, go to StockChartsTV.com. That's our on-demand platform. There's such fantastic content in uncertain times when the market is getting very choppy with drawdown potential and leaving you with question marks in terms of what to do. We are here to help you. We have a great group of experts to help you make sense of things. All of our market outlook specials from the last couple of weeks are there, from Larry Williams, from Martin Pring, Bruce Frazier, and our official market outlook called Charting Forward 2022. All of that on demand and so much more. Go to StockChartsTV.com to access all that content for free, or on your mobile device, just search on any of the app stores for StockCharts TV on demand. Our next segment is the Final Bar mailbag. As a reminder, email us your questions. We'd love to hear from you and hope to answer yours in our next mailbag segment. Let's get to question number 1. Would you mind explaining the significance of gaps on a chart? I've heard analysts speak about them, but never understood their influence on price action. It's a really good question. And so what I would generally tell you is price gaps are basically telling you, right? Think about the normal way that a stock trades, right? You have the normal trading session between 9:30 a.m. and 4 o'clock p.m. Eastern. And then you have extended hours, after hours sessions, pre-market and post-market, of course, but most investors pay attention to that main that May part of the trading day. What a price gap means is basically from 4 p.m. one day to 9:30 a.m. the next day, there is a change of some sort. And if you think about it, if you look at the average price chart, you'll probably see a gap every 3 months or so. And that's because of an earnings release. Usually when a company reports earnings, you will often see a gap from one day to the other. The reason why there's a gap on the chart is usually one of two things, right? An earnings release, which is the common reason for gaps on an equity chart, or some sort of one-off news, right? Something like Activision Blizzard being bought by Microsoft, or Peloton with the news or the implication that they're not producing bikes anymore. That's going to cause a gap, a big news event, because there's a chain, right? Something's changed. If price represents sort of what people think about the long-term prospects of this company looking forward, and if those prospects or the expectations for the future of the company change, then the price is going to change. And if the markets are not open at that time, you're going to have a gap. And so that is the reason why gaps occur. What do you actually do with them? Well, there are a lot of different things you can do it. I have the chart of Apple just because it's something that came to mind. I remember this gap vividly in July when we gapped higher. So a number of things that people do. A lot of times it's a very obvious form of support and resistance. So if you look, we gapped higher here, had a couple gaps in a row, actually. We then rotated higher and then came back down. And not surprisingly, we found support at that gap level, at that breakout level. If you think about it, that is when that gap is when you have an initial change of valuation. People overnight decide for some reason or other that Apple is worth a very different amount than it was at the previous close. And so a lot of times that is a meaningful level. It's sort of an anchor price going forward. So if you look left on the chart and you're looking for support and resistance levels, I would always key in on gaps as potential areas of support or resistance. This is the best I can do in a short period of time. I would encourage you to go to our chart school section of our website, search for the keyword gaps, and you get a lot of information more about the trading mentality and how to use them. People talk about filling the gaps and how to use them in a little more detail. There are different types of gaps, breakaway gaps and exhaustion gaps. Just don't have enough time to go through all that, but check out our chart school page for more on that information. Next question, are you aware of any technical measure that combines correlation and relative strength? I'm looking for a simple indicator that combines both. Let me know if you are aware of a specific indicator or something close. The short answer is no. I don't think so. Relative strength, assuming you mean relative strength of a stock versus other stocks, there are very few indicators that are derived from relative strength, to be honest with you, besides doing simple technical indicators on the relative strength line. To be honest with you, the thing that comes to mind, I'd have to look up and see how much correlations are involved in this, because I don't remember how much, but it makes me think of Gary Anderson's work. He wrote a book called The Janus Factor. And it's probably in the last 10, 20 years, one of the most innovative additions to the technical analysis toolkit, I would say, in terms of adding to the body of knowledge by talking about how stocks move relative to one another, and not just relative strength, but relative strength on steroids, and thinking about scatter plots of the movements and how the range of relative performance expands and contracts based on what traders are doing. I thought it was really, really well done. And again, I'm not sure how much correlation actually does that. But that's what comes to mind. Is that a simple indicator? No. I mean, he had a bunch of derivative indicators that were pretty interesting, but I'm not sure of one. I'd be very interested. Whoever wrote the question in, if you do find something interesting, let me know, because that's not an area. Correlation is something a lot of investors don't really use because it's hard to really draw direct actionable ideas from it. It's more of a interesting descriptive thing to understand how stocks and gold move relative to one another and when that relationship changes. And I think looking at John Murphy's work on intermarket analysis certainly relates to correlation and relates to relative strength, but not necessarily as an indicator on a chart. So the answer is no. I'm actually not aware of a specific indicator that combines them. If someone check me if there's something I'm missing, please let me know in the comments or email me. Next question, what do you think about a possible Russian invasion of Ukraine and its effect on global markets and commodities? So I actually did an interview with Reuters earlier this week, and this exact question or something along these lines I was asked. And my basic answer, which I'll share with you, was not a lot right now. And I think if you look over time, if you look historically, there are times when military actions, geopolitical events, if I would bucket this generally under that category, can have direct implications on stocks. And I think the way to think about it is how much does that event really impact the global economy or a particular economy? So, would that affect like the Russian market or, a Ukraine market, if that was a tradable market we looked at a lot? Certainly that would have implications because it has implications for the companies that are trying to operate in those areas. The thing is, and I think the reason why not is because it's probably a couple levels away from, particularly for US-based investors, what is in their sphere of attention if you're trying to understand, what's happening with the US economy. I don't necessarily think, unless it escalates much more than what we've seen so far, it certainly could. I think the other problem, and the reason why you're not getting as much of a reaction that I think you could attribute to that, is because we're already dealing with a lot of really major, major market driving things, right? The whole coronavirus, the whole COVID-19 pandemic is a huge event and series of events with direct market impact or implications. The whole economic shutdowns and whether the economy is reopening or not, and how, has certainly impacted things much more than I think a military action at this point probably ever would. The Fed and what they're probably going to do, and rising rates and inflation, these are real issues that are really driving the markets here. So I think that's why this particular one, you're probably seeing a muted reaction. And if the market does move and you see it attributed to that, I think it's more trying to draw some relationship that may not necessarily be there, to be honest. Next question, this is probably the last one we have time for. You recently talked about the advanced decline line for SPX, the S&P 500, but in StockCharts, I can only find $NYAD and $NAAD. Can you tell me how I can plot the advanced decline line for the S&P 500? A really good question. And I would tell you the short answer is if you go to my Mindful Investor Live chart list, you find that if you click on the articles tab and then go here where it says all StockCharts blogs, go to mine, which is called the Mindful Investor. There's a little gray button at the top that gets you this live chart list. That's the chart list that I refer to every Friday, and often during the week I'll randomly do it. And the third chart in that list is this one. If you click on it, you can actually see the indexes that make this up, and I'll bring it up real quick in case you want to jot it down. These are the lines for New York Stock Exchange common stock only, the S&P 500, the S&P Mid Cap Index, and the S&P Small Cap Index. Those are breadth indicators that our StockCharts data team keeps updated every day, every trading day. Right after the close, they'll process all the closing data and put it on there. $NYAD and others are probably coming from an exchange. It might be an official listed NYSE report of advances and decliners. But we have a lot of our own data that we're able to crunch because we have the individual data or data for individual names. Part of the thing that's on my list as chief market strategist of StockCharts is to make some of these breadth indicators a little easier to find. So I'll see what I can do on that. But that is the way you do it. And go to the Mindful Investor Live chart list. You can copy that chart into your own login and do what you want with it. That's all the time we have for our mailbag. Again, keep your questions coming. We very much appreciate them and appreciate you. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P with a bullish percent index. Talked a lot about breadth earlier in the week. I think with Andrew Thrasher, if I remember right, on Tuesday's show or Wednesday, we talked about breadth conditions and how they were evolving and certainly turning more negative over time. I wanted to point out that the bullish percent index has gone below 50% this week. I think it happened on yesterday, on Thursday's session. This isn't updated yet for today's session, but most likely, given the weakness into the close, it's going to go even lower. Remember, the last 8 times that has happened, it has been a very buyable pullback. And I've highlighted in purple those times when this index has gone below 50%. The reason why I think it's a risky move right here is because much deeper drawdowns in terms of time and or price have also had this exact look until it just continues lower. So the question is it a brief pullback? Are we back up within a week or so? And if it does not recover, I think you got to brace yourself for the potential for a much deeper drawdown, or at the very least, a much longer period of time spent in more of a corrective phase. This is a really important chart to watch, I would argue, in the weeks to come. Second chart is the IWM, the Russell 2000 ETF. We've talked often on this show about how small caps really didn't participate in the bull market phase last year. February 2021 to December 2021, you really didn't go anywhere, sort of at the same level. Now in early 2022, we've now broken down and we've undercut the lows that were an established range. This is a basing pattern for quite some time. So look at what happens with small cap stocks in the last couple of months. You went from a failed breakout to now a confirmed breakdown so far. Remaining below that level maintains that bearish thesis on stocks overall. Finally, the XLY, the consumer discretionary sector, breaking below its 200-day moving average. The S&P 500 attempting to hold its 200-day, failing so far. Look at how the XLY is underperforming the S&PY, but even more in terms of risk assessment, underperforming consumer staples. People own consumer staples when they're getting nervous, and that's what we're seeing the investors rotate to. Folks, that is a wrap for this week on the Final Bar. Thank you so much for joining us every weekday after the close. We'll be back to 4 p.m. Eastern every weekday starting next week. For StockCharts.com in Redmond, Washington, have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.